We're live.
Good morning, everyone, and you're welcome to our webinar. I'm just going to give it another minute to let people join, if that's okay. Okay, I think we'll kick off. So good morning, everyone, and you're all very welcome to our webinar, which is the May version of our series of webinars. We're holding them on the last Wednesday of every month, so next one on the 24th of June. Broadly, we plan on speaking for 45 minutes, so hopefully we'll get a quarter of an hour back in your day at the end of it. My name is Ollie O'Connor, and I lead the private client business in Geant Thornton. The private client business, as you will see, combines 4 different areas, which are all very much interlinked, but they start and finish with you, the individual. There's normally a crossover between companies that you might own and where you get your earnings from, but the service is primarily to individuals and their tax and financial needs. As with all of these webinars, we're very conscious, and there's over 150 have registered in so far this morning. There are a number of different people at different phases of their lives. Some are still accumulating their wealth or trying to accumulate it. Some are on the verge of deciding whether to retire or not, and some have retired. So we're not trying to cover everything in one webinar, but what we are trying to do is cover off a number of topics that we have advised clients on over the past couple of months, and hopefully they are relevant to a number of you on the call today. So today we're covering 4 topics. Firstly, Debbie Fry will address those that have accumulated pension funds in their corporates and the use of PRSA structures and what they offer. Important on this to say that it is not about putting in significant money into a pension fund now. This is about funds that have already been accumulated. There are in excess of 12 different pension structures already in existence. So our role here, as we see it, is that we want to make sure that you're in the right structure for you. Thereafter, Una Ryan will take the very topical area of the individual business reliefs that are available, succession planning and entrepreneur relief, and how people are using those to tax efficiently take wealth from their corporates and the whole area of succession planning. And then thereafter, Liam Nocton will, for those who have accumulated wealth and are of a mind to help their future beneficiaries, how to pay the inevitable tax liability that will arise. He will go through a number of examples as to how you might mitigate some of that tax. And finally, certainly over the last couple of weeks, and probably more pronounced since Leo Varadkar's comments in the Dáil last week, there's been a lot of speculation regarding what may come in the upcoming budget or when additional taxes may arise. So I'll outline some of those concerns and, more importantly, the actions that some people are taking to mitigate the fear that is being caused by the speculation. We must say we don't advise based on speculation. However, I think it's only right to cover some of the points that are being raised, and so people can make their own decisions on it. Just a couple of points to make in terms of, there is a Q&A button there. So if you have any questions, please feel free to put those in, and at the end we'll answer as many as we can. And if we don't get to answer on the webinar, we'll certainly come back to you individually. And finally, we will be sending out the slides to everyone who has registered just for their own benefit. With that, I'm going to hand you over to Debbie Fry and let her take you through the first piece. Thank you.
Okay, thanks, Ollie. I suppose as a salaried employee or director in a company, there are a number of options available as to how a pension is structured. And the most suitable option would normally be a company pension scheme, namely an executive plan, given the generous funding limits that are available from an employee and employer perspective. However, as Ollie noted today, I'm going to focus primarily on the different structures from a retirement point of view, and to try show you how with a little planning you can structure your benefits a bit more efficiently. Now on this slide here, you can see a comparison. If we just go back to the previous slide there. So on this slide here, you can see a comparison between both structures. And I just want to, I suppose, draw your attention to a couple of these points. Both options are available to a salaried employee or director for funding purposes. However, as I've just mentioned, there is greater scope to fund from a company scheme structure in comparison to a PRSA. However, if you have a company pension plan and do want to consider transferring to a PRSA structure, it does need to be done within 15 years of when you started pensionable service in the company, and that's really important. The latest retirement date under a company plan is age 70, whereas under a PRSA it's age 75. And this allows you to avail of an additional 5 years tax-free growth on some or all of your pension assets, and it does give you the option to delay retirement of the benefits. Current pension legislation does stipulate that all company pension benefits relating to the same employment must be retired at the same time and in the same manner, whereas a PRSA is classed differently. It's a personal plan essentially. Therefore, under a PRSA contract, you can retire the funds at different times and also elect a different option in relation to them. I suppose the death benefit available under each is probably the one of the most important factors I think people do need to consider, as having your funds in a PRSA arrangement does ensure that benefits will be paid in full to your estate in the unfortunate event of your untimely death. The next slide here shows you, I suppose, what in practice would happen to your benefits under each structure in the event of your death while in active pensionable employment. So under the company pension scheme, the maximum payable on death while in pensionable service is governed by a 4-times salary rule. Now there is a refund of any personal contributions paid on top of that. However, if we assume that you've used your company to solely fund your pension, which would be quite common, you would be looking at only getting a portion of the fund back as a lump sum, and the balance would be used to purchase an annuity. Now, as many of you probably know, annuity rates are very low at present, and gone are the days that I suppose we could secure a rate of 10 or 12%. If we get a rate of 3.5% these days, that's doing quite good. And the younger you are, the less favourable the rate you will get. So when we consider this against having your funds in the PRSA structure, where on death and service, the whole fund gets paid out to your estate. So obviously from your beneficiary's point of view, it's a lot more lucrative. On the next slide here, we are looking at how we would actually go about restructuring your benefits. The first thing that we do need to ensure you do is you utilize this option before the 15th anniversary of your pensionable service. That is an absolute key in this. And once we have clarity on that, we can wind up the company scheme, transfer the benefits into a PRSA structure. Now there is a process involved and it is relatively straightforward, paperwork involved, but sure, look, that's the nature of many businesses these days. And it is really important that you fully understand the reasons behind the transfer and that we do make sure that everything is in order from that side. Once we have the PRSA set up, we then have the option to establish a new company scheme and pension fund through this, utilising the revenue limits available, and subsequently planning the drawdown of these benefits as you hope to retire. Now, our current economic environment is a clear example of how one's financial circumstances can change. Therefore, regular reviews of your benefits and financial plan is really important to make sure that you have a clear understanding of what benefits you have and when you need to take them. Now, when it comes to a time that you need access to cash or indeed income, what we can then do is split your PRSA into a number of PRSA contracts, which you then can draw down individually as you require before age 75. The benefit of this being the flexible phased retirement. It is very unlikely that you will need access to all of your lump sum or pension income at once. Therefore, if we structure it in this manner, we can essentially tier your access and plan accordingly. Now, based on revenue limits, you are entitled to a lump sum of up to 200,000 tax-free from all your pension sources. And any lump sum taken between 200 and 500 is taxed at 20%, and over 500 is taxed at 40%. So in this example, we've assumed you have an overall pot of 1 million, but we split it into 2 PRSAs to facilitate this phased drawdown. There is a benefit to delay the drawdown of your pension as long as possible, given any income that you do draw from the pension is taxable. However, under a PRSA, you can avail of retirement from it from age 60 if you need to. So if we assume you have a need for cash at age 65, loads of circumstances, child getting married, you want to help them get on the property ladder, buy a boat, go traveling, whatever it may be, having split the plans, we can actually facilitate that and give you access to a portion of your cash. The balance fund available would be moved to a post-retirement structure, but you do have to take income at a rate of 4% from the post-retirement structure, and that increases to 5% from age 70, and that income is taxable. The other PRSA plan that we have separated out has to be retired before age 75. However, there's no obligation to draw it down at the same time. So you're essentially staggering your retirement in line with your financial circumstances. So I suppose key takeaways from me on all this would be you do need to consider your pension funding. The optimum way to fund for retirement is through a company pension structure, given the revenue limits and the scope. You can also fund in respect of past service as well. So if you're at the journey of funding, it is really important you consider that. You can protect your beneficiaries by ensuring your arrangements are set up appropriately. Having some of your benefits in a PRSA contract does ensure that that part would be paid in full to your estate and not caught up in the 4-time salary rule. By transferring to a PRSA, it does give you the benefit to stagger your drawdown over a number of years and phase your access to cash rather than drawing down everything at once. And it's really, really important to pay attention to the timing when you want to consider a restructure, as this option is only available before the 15th anniversary of pensionable service. So you do need to consider that. So now I'm going to pass you over to my colleague Una, who's going to bring you through the area of succession planning.
I'm going to do it from the perspective of the individual leaving the company as opposed to any recipients, and we can cover that in a later seminar. So while I agree with Ollie that we don't advise on speculation, I can say with certainty that the costs of the business and employee bailout will need to be funded. I mean, it's splashed all over the papers this week how much of a deficit that we are in the economy. So one thing is certain, taxes will not reduce. They either will remain the same, or we're looking at increased CGT rates, which is your capital gains tax, currently at 33%. We're looking at increased property taxes. We're looking at possibility of wealth tax introduction. We're also looking at the possibility of reduced or capped business property relief. We're also looking at the possibility of reduced retirement relief. And as Ollie said today, the main focus of my presentation is going to be on entrepreneur relief. And we are looking potentially at a restricted or even complete abolition of entrepreneur relief, which is obviously not an ideal situation. So why is that relevant for today? Today, we know the taxes. It's very certain. We know what reliefs are available, we know the tax rates, and we also know how we can go about that. Also, some issues to look at is your valuation of your company. So it probably is a bit hard to put a number on the valuation of a company in today's climate, where turnover is either non-existent or completely down. But it also might be a way of looking at it to see, okay, is now a time to exit the company? How much time do I have left, really? Is it a year, is it 2 years, or is it in 10 years' time? And if it's now, then it could be a good time to exit from the company, because low market values obviously mean lower tax liabilities for all parties. We kind of look at succession planning or exit from companies or sole trader through a timeline. So we sit down with the client, what are their objectives? We need to know, as I said, are you looking to retire now, or are you looking to retire in the future? How are you going to go about that? Have you a plan? Is it that you want to gift to your kids, or is it that you want to sell the company, or is there a management team that are ideally looking for a buy-in into the company? Then there's the time horizon, and some of that is quite relevant for some of the reliefs. You'll see as we go through some case studies that I've highlighted here that you have to have held the shares for 3 years in the case of entrepreneur relief, 10 years in the case of retirement relief. You also have to have been working in the business. And again, do you want a partial exit? Also looking at how are you going to fund yourself in the future? Because obviously if you sell the company or you gift the companies to kids and you're no longer working in the company, that's an income tax stream that is suddenly cut off. So it's considerations around that you'd be looking at as part of a succession plan for yourself. In terms of exit then, there are a number of different options. We can do a buyback of shares, and I'm going to give you a case study on that. That's where you have sufficient cash in the company and you can buy, basically the company buys back the shares. You can look at liquidation of a company, sale of a company, gift of shares, and then there's other mechanisms to get cash out of the company, such as termination payments, and as Debbie highlighted, there's actually pension planning and having a corporate pension in place. So I suppose just moving now to our first case study, which is a buyback of shares. So traditionally, this was always something that people shied away from, because what you had to satisfy the trade benefit test, and you also had to go into revenue to get clearance from revenue. Revenue are no longer giving clearance on the trade benefit test, and they're basically saying that this is completely self-assessment. We now have to satisfy all the conditions ourselves, and they're no longer giving kind of what was previously the stamp of approval on this. So in this case, TradeCo is held by 4 different people, and mum and dad want to completely exit the company. The child, they don't want to gift to the child because they want money, and they don't want to sell to the management team because the management team are already there and they don't have the funds to buy mum and dad out. Now, TradeCo does have sufficient funds, and that is really important for this to apply. You do have to show the cash on the balance sheet, and you have to show that you've got sufficient working capital cash left over after you buy out mum and dad. Revenue do not like if the company goes for a loan to buy out mum and dad, so it has to be that you can prove that there's sufficient cash on the balance sheet. There's a whole load of other kind of company law requirements as well. You need distributary reserves, and it has to benefit the trade as to why mum and dad are exiting the company in this manner. And generally it's because you would say that child 1 and management want to grow the company, they want to expand it, and mum and dad are at odds with that expansion or at odds with the direction of the company and how it's going. So essentially what this means is you can actually, TradeCo can actually buy back mum and dad's shares, and you can get CGT treatment, which means it's not an income tax distribution, and it's taxed at 33%. And then entrepreneur relief can apply. So if entrepreneur relief applies, then essentially mum and dad can each get $1 million at 10% and the excess at 33%. Now, there are a number of conditions, as with all taxes. Mum and dad must have held the shares for 5 years, they must be resident in Ireland, and they cannot be connected with the company post buyback. So this is often where we run into a bit of difficulties with clients, because mum and dad will say, oh, I want to hold 5 shares in the company. And if they do that, then they're deemed to be connected with TradeCo because of the shareholding that their child has. So it's managing those sort of things. Generally, when we do a share buyback, we want them out completely, as in we don't want to be left with any shareholding that mum and dad have in the company. So using this mechanism, it's a full buyback of the shares. And again, the benefits of a share buyback is that it uses company cash and it gets company cash out at CGT rates, and then you can obviously claim entrepreneur relief if you satisfy all the conditions. So just moving on then to the next case study. And again, so the second option, if let's say the company, you look at the company's balance sheet and it doesn't have sufficient cash, or it doesn't have sufficient distributable reserves in order to affect the share buyback, then another option that you could look at is a management buyout. So this is where you've got a really strong management team in place, and they want to buy into the company. So what they can do is they can essentially set up what's called a bidco, i.e. a new co. They are the shareholders of the bidco, and what happens is bidco goes to the bank, looks for funding from the bank, and bidco then buys out mum and dad from the TradeCo. And again, mum and dad will be subject to capital gains tax at 33% unless they qualify for entrepreneurs relief, which means again that they pay the first 1 million at 10% and the excess at 33%. So this is and was a very common structure. I suppose the only kind of fly in the ointment in recent years is that what happened was before was bidco used to get a loan from newco and would use newco's funds to buy out mum and dad. This can't happen at the moment due to a nasty little piece of legislation that was introduced 2 years ago. And it essentially said that if you use company funds in this manner, then you will be subject to income tax when mum and dad sell their shares to the bidco. And it's very different to the share buyback. In fact, they actually clarified that when you do a share buyback and the company uses its funds to buy back the shares, it's not treated as a distribution. So again, this can be a useful way for mum and dad to get money into their own hands, dispose of their shareholding to the bidco. And again, there's not as much onerous conditions around a substantial reduction or being connected to the company post sale of their shares. There are some of those conditions, but they're not as onerous as the buyback provisions. So again, that's just a second option that you can use to get cash into mum and dad's hands when they're looking to retire or exit from the business. So the next option is that there is no children there that they want to gift the shares to, that there is no cash in the company, or that there's no other shareholders that are interested in running the company. So then you could look at a liquidation of the trading company. Liquidation of TradeCo, though, and to claim entrepreneur relief is just a little bit tricky in that the trading company must actually be trading at the point that the liquidator is appointed in order for you to get entrepreneur relief. So first principles, if you liquidate a company, all the asset, all the cash or whatever is in the company comes out at CGT rates, so that's 33%. But then in order for you to qualify for entrepreneur relief, Revenue specifically state that it must be a trading company at the point of liquidation. So generally that is, you issue your last invoice the day that the liquidator is appointed, and that should be sufficient for entrepreneur relief to apply. And then again, it's back to 1 million at 10% and the excess at 33%. Now, if it's been left a little bit too late and you come into us and the company has been ceased trading for the last few months and there's no way that you can say that entrepreneur relief will apply, then retirement relief could potentially apply in that instance. And retirement relief would say that you get 750,000 completely tax-free, with the excess at 50% of the excess. So again, that mightn't be an ideal tax answer, because it's not that you get the first 750,000 completely tax-free, it's proportioned out based on the proceeds coming out. So if TradeCo was worth 1.5 million, then that would be an ideal answer. You could liquidate TradeCo, claim your entrepreneur relief if you satisfy all the conditions. The fourth way of exiting the company is obviously gifting all the shares to your kids. And I didn't really cover that because obviously the whole objective of this seminar is to get cash into the exiting person's hands. And obviously if you gift shares, no cash comes to you, but there are relieving measures there that you pay no tax. So I suppose I'm just going to finish by, I'm not going to go through it in nauseating detail, but I have kind of conditions that must be satisfied if entrepreneur relief is available. And again, you have to dispose of a qualifying business. So that is that it has to be wholly or mainly trading. So it can't be an investment business that you're holding an investment portfolio of shares, a number of rental properties, or that it's actually not actively trading. It has to be a trading company in order for you to qualify. The person who's disposing of their shares must own at least 5% of the ordinary share capital of the company, and you must spend at least 50% of your working time in the services of that company in a managerial or technical capacity. So I'm working on a case at the moment where they're selling their shares and they satisfied near all the conditions except for that they didn't work full time in the business, nor did they work 50% of their time in the business. And unfortunately, they're not getting entrepreneur relief. So it is something that has to be watched out for. And especially if you're going to do a bit of tax planning between spouses or hire spouses and appoint them as directors or employees in the company, they have to be working in the company in order to avail of entrepreneur relief. Again, retirement relief is available, and I've on the next set of slides, I have some of the conditions outlined there. You must have held the shares for at least 10 years, and you have to have been working a director for 10 years and a full-time working director for at least 5 of those 10 years. So the conditions are slightly different, and they have to be managed in all cases when you're looking to exit a company. So as I stated, this is more from the donor side or the exiting individual side, and it's just a number of options that is available to a person, provided all the relevant conditions are satisfied, that you can extract some cash from the company in a tax efficient manner while the reliefs are certain, because we don't know what will happen come October and the budget and fill in the hole that has been left as a result of COVID-19. Thank you. So I'm just going to hand you over to Liam now.
Thanks, Una. It's almost good morning, everyone. What I'm going to bring you through is just a very simple technique that we've used for clients who don't want the tax liability that's going to fall on their beneficiaries to be overly onerous, especially when it comes to liquid assets that can cause a bit of trouble when it comes to trying to pay those liabilities. So first of all, just for a bit of an outline, we know, well, most people here should know that there's 3 thresholds that apply to individuals when it comes to inheriting gifts from different individuals. So in Group A is when you inherit a gift from your parents, and at the moment our threshold is 335,000 euros over your lifetime. And then Group B and Group C aren't as generous, and therefore more other family members and then members outside of your family. The one thing to note here is that we have our thresholds in place for our lifetime, but we also have a small gift exemption in place where any individual can gift another individual 3,000 euros a year. And that doesn't affect your threshold, and there's no CAT liability in place. There's no tax payable. Some families that we've seen and we've dealt with, they don't realize that the benefit is here. So if you have an individual and they have a spouse and you've got 2 sets of parents, you're creating so many relationships that all create a 3,000 euros, not a loophole, but an opportunity every year. But a lot of people don't realize that it's there, but what they also don't realize is that if you don't act on it now, you lose it. So you've got 365 days a year to use it each year, and if you don't, it's gone. So just on to our next slide here, I want to talk about Section 72 life insurance. So it's essentially whole of life cover that's in place, and a lot of people would have seen whole of life insurance in previous years. It's pretty much gone away now, unless it's for this specific purpose. It just becomes quite expensive in terms of life cover compared to one that you might set up for a defined period of time. If it's written under Section 72, the life insurance that you're paying for is used to pay a CAT liability that falls on the beneficiaries of your estate. So for example, if we have a husband and wife who have 2 or 3 kids and they've got significant assets that are going to pass on their death, well, you will have your thresholds to use each, but there's an awful lot of people out there who are going to create massive tax liabilities on their children. And we've seen it most effective for people who have property portfolios where they might be looking at the properties and saying, well, I want X and Y property to go to this child and I want another 2 to go to another child, and we don't plan for them to have to liquidate it. So if we get to a point where the couple pass on and then there's a massive CAT liability coming out the other side, or not even massive, even a smaller one that you can't afford to pay because all of the assets you inherit are liquid and the intention was never to sell those assets, then where are you going to find the cash to pay this liability? So who is it suitable for? It's people who want to set up a life cover that will pay inheritance tax for their kids. It's going to have to be set up on a whole of life basis because we don't know when we're going to pass, no matter how many life expectancies we try to plant and so on. There is a chance, particularly when there's 2 spouses, that one can live quite longer than they're expected to. It's especially effective for people with larger inheritance tax bills. One reason for that is because it is quite hard for us to know what is the liability going to be in 30, 40 years time. It's essentially a best guess in some ways, because it's always going to be based on current rules, current thresholds. So one important thing to note is that we would never be looking to over-insure or insure the exact liability we think is going to arise in the future. We just want to focus on a liability that you don't want to arise, where cash needs to be found where there may not be anywhere to get it. If we look at how it's structured, there's more ways to structure it than what I'm showing here, but this is almost the most effective or most comfortable way people like to set it up. So we've got single life cover for someone who doesn't have a spouse, or if they have assets that they plan on passing to their kids before their spouse dies. So a lot of the time we'll see it being set up by a husband and wife on a joint life second death basis, because if spouse one dies, it's assumed that a lot of assets are going to pass to the other spouse, and that would be tax free. So there shouldn't be a large liability arising until the second spouse dies. But if there is a tax plan in place where certain assets are going to pass on the death of the first spouse, then you can look at a single life cover also. Guaranteed premiums are a big thing for us. We don't like people not to know what the future cost of something is going to be. So if you set up life insurance now, it should be on the basis of how much cover am I setting up and what am I going to be paying. There's a couple of ways that this can differ. One is if you actually index the level of cover, you also index the premium that's payable. But if you're indexing a premium payable by 3 to 5% a year and it compounds over 40 years, you are going to be paying an awful lot more a month than you would have been at the start by the time we get 10 years, 20 years down the line. It also gives people certainty, and it gives them comfort to know how is this going to affect my cash flow over the next period of time. Level cover is also important because we don't know how thresholds are going to change. We don't know how lifestyle is going to change, how requirements are going to be changed, and if there's going to be gifts before the actual intended time. So we like to set it up on a basis where it's either single or joint life, depending on what your circumstances are. You want to know what you're going to be paying. That's very important. And you also want to know what you're covering. There's another way to set it up where it's reviewable and you have a set level of cover and premiums for 10 years, and then it's reviewed. But every review period, you are actually being repriced based on your age at the time. So you either reduce your level of cover or you start paying more. And that's, for us, it's not the ideal situation, the most optimal way to set it up. So moving on to the next slide. This is a case study, and it's just to show how people tend to look at this kind of cover and how they probably should look at it. So obviously, the earlier we try to plan for inheritance for our family and so on, it's harder, or it's more of a guess in terms of what is my liability going to be in the future. However, there's a massive benefit to people who actually try to plan for this ahead of time. So I have a case study here with a couple who take cover out at age 60 and one where they take it out at age 70. So it's a husband and wife set up on joint life second death. The sum assured is 500,000, not because we think the overall CAT liability on the kids is going to be 500,000, but that's the portion of the liability we want to insure. That's very important. So if you look at a couple that are age 60, it's payable on the second death. So that could be age 61, it could be age 101. We're not sure. But if we know what the cost is going to be and what the benefit is going to be, we can work out a cost benefit analysis. So for age 60, you're going to be paying this for a longer period of time, assuming that you live until life expectancy or a bit longer. And at age 70, you're obviously going to be paying in a shorter period of time. Now the cost difference is huge between age 60 and age 70. It's essentially twice as much if you take it out 10 years later. And it's not a case where it's prorated back and by the time you're 100, you'd have paid the same amount in. If we look at the actual cost of a policy to age 100, I think a lot of people would assume that that might be as far as they'll go. Some might go further, but a lot of people might be a bit shorter too. The earlier you take it out, the more affordable it is. So if we actually took out a policy, age 60, husband and wife, for $500,000 at this moment in time, assuming all health conditions are met and there's no underlying conditions that need to increase any prices or ratings, you actually wouldn't pay the sum assured out by the time you're 100 in premiums. And a lot of people look at that as the break-even point. So if I'm getting 500,000 out, when will I have paid 500,000 into the policy? It's not actually that simple, and a lot of people take that for granted. So if we move on to an illustration of both scenarios, if we take the middle line, the purple line first of all, that's 500,000. So that's your liability that you are covering, and that is the amount that's going to be paid out of the policy on death, whether that's in year 1, whether it's in year 40, any time in between. The green line at the top is the cash you would need to keep back in a bank account or anywhere else if you wanted to say, I want to cover this liability for my kids, for my beneficiaries. So if you had a property or a number of properties that were going to your children and they were passing to them on death, and you didn't want them to have to liquidate any properties because maybe they don't have cash behind them or there is no other cash that they're inheriting, well, you would actually need to keep back nearly 750,000 of cash to pay that liability, because that cash will also be subject to CAT at 33%. So that's really the break-even point, and it's up until that point is where you actually have profit or value in the policy. So if we look at the grey line here, that's premiums paid over every year of the plan. And even in this case where you take it out at age 60, you're looking at the break-even point people assume is relevant, even though it's not. The green one is what we want to, or we need to not reach for the policy to be of value. We're still only hitting 500,000 of premiums being paid in 45, 46 years time. So there's huge value when you take it out at 60. Now on the next comparison for age 70, yes, it's more expensive. It is of less value or less profit on payout, but a lot of people get hung up on the purple line meeting the grey line. But the value in the policy is the grey line meeting the green line. And that's what we have to look at. And even when a couple taking out cover at age 70, they still have value in the policy up until the time that they reach just over 100. So yes, there is a risk someone could live past 105, and more power to them, and we hope they do in many instances. But if we look at it from a planning perspective and life expectancies and so on, there is a lot of value in these policies. Now, the reason why there's value in them is because there is take up, but then because the length of term for the policies is so long, there are instances where people, they just need to stop paying in because something happens, they can't afford to do it anymore. Now, what we would say is that you shouldn't be looking to set one of these up if you know that you definitely can't fulfill the cash flow requirements, and we can work on that with clients to make sure that they can afford it and show them where to take the cash from. For example, on a property portfolio that might be rented out, you would be taking a portion of the rental income every month and just paying the premiums from that. Another very important thing to think about is that when a retirement fund, so an improved retirement fund, is inherited by a child who's 21 years or older, there is a special income tax rate of 30% on that fund when it passes to the child. This type of policy can also pay that tax. So that's quite important. But for other clients who are especially wealthy and they see the annual distributions from their approved retirement funds as a bit of a burden because they don't want to take the money out, they don't need it, and they're paying tax on it, some of them can reroute the annual distribution from an approved retirement fund into their premiums for this policy, because they're not just taking extra cash that they don't really need to spend and putting it in the bank. They're putting it into a policy that will reduce the CAT burden on their kids in the future. Other than that, there's a few different features that you can add in. For example, some providers offer options where there's a guaranteed amount that's the most you'll ever pay, where for certain cases and premiums, you don't have to pay any more premiums if you reach age 100, and a policy will always be alive until the second death occurs, or the first death if it's a single life policy. Other than that, it's very much a case of you, the individual, needs to sit down, do a tax plan, figure out what you want to do with your assets, when and how. And if there is going to be a liability in the future, the question one is, do I want to cover a liability that might arise on my kids? A lot of the time when there's property involved, the answer is yes. But it's very much each to their own. So absolutely reach out if you want to go through any of that with us. But another thing that a lot of people are not skeptical about on these types of policies, but a lot of people have had failure in setting them up where they reach a certain age. So a lot of people think they get to 70, 72, 75, they can't get this cover anymore. You can in certain circumstances. We've had a lot of luck recently where one individual might be 75, 76, but if their spouse is a little bit younger, it can be set up and priced in a way that both spouses are covered. And the spouse that's underage, so the one that actually fits the requirements for the policy, they get medically underwritten, but the spouse who is actually overage doesn't have to go through the underwriting process. So it can be very useful. So if you've ever had trouble and just assumed I'm too old or my spouse is too old to get this cover, absolutely we can look into it, because they're hopefully we'll always find a way. So just to summarize the benefits of this, one key important point is don't overinsure. If there's a liability of 500,000 and you've insured 600,000, the extra 100,000 is subject to CAT at 33%. So we want to look at a liability on specific assets and say, okay, we're going to insure that. We're just not going to try to insure every single part of the liability that's there. It's highly effective for liquid assets. If you don't want family or beneficiaries or kids fighting over, we don't want to sell this property, I want to keep this property, this will fund the liability to stop them from having to do that. If we plan earlier, it's more cost effective. We've seen there in the case study, the earlier you take it out, the less of an impact it has on cash flow, because the premiums are cheaper, but it also ends up being cheaper over the long run anyway. And then age restrictions may not apply. A lot of people do say they've had failure in getting this cover before based on age, but if there is a spouse who is a couple of years younger, or even if it's been in the last couple of years you failed, the rules are a little bit more flexible now, that we can try to get you cover. We can try to work with an underwriter to see if we can get it in place. So I'm going to pass you back on to Ollie now, and he will go through expected changes in the future.
Thanks, Liam. Una probably stole a bit of my thunder there in terms of the likely changes, and I know you should always finish on a positive note, but I think in the times we're in, it's probably right to just go through in realistic terms a number of points that are potentially going to change over the course of the next while. And I mentioned the Taoiseach's comments last week in the Dáil, so just to read those, and they have been off quoted since, but I am concerned that there's a growing narrative and belief that we can, as a country, borrow cheaply forever, and that this is the solution to our problems. It's the free money argument, and it's coming from the right as well as from the left. There's no such thing as free money, and there is no such thing as a free lunch either. So obviously, depending on people's political views, he's an acting Taoiseach, he's not in power really, but it is likely that there will be some form of government over the course of the next couple of weeks. And I think irrespective of who is in power, we will ultimately have to pay for our own liabilities and reducing the national debt. I see in this morning's papers, IFAC, who are the advisory board, are saying that we have in effect wasted the excess 6 billion a year on corporation tax over the last couple of years, and that we should have saved it for times such as these, which again is probably very easy to say with 2020 vision. I suppose in terms of the people on the call, probably the easiest thing to say is that we would all believe that the fairest tax is always the tax that we as individuals don't have to pay ourselves. But I think in terms of setting the scene on this, probably Ronald Reagan's view on economics was that if it moved, you had to tax it. If it kept moving, you had to regulate it. And if it stopped moving, you had to subsidize it. Well, we're absolutely in the subsidized territory at the minute. And I think on a personal level, I think we will still be in a subsidized level for the broad economy into 2021. So I'm not fully convinced that there will be many significant changes on the tax side in 2021. But I do think they're coming, and I do think they are going to hit this cohort on this webinar quite hard when they do. So I thought it might be worth just taking us through a couple of the areas. The first one is the pension levy. It'd be interesting to see how many people actually remember the pension levy that was there. There was a pension levy from 2011 to 2015. It was at 0.6 at the time, and it became 0.75 for one of those years. And it was done based on valuations of pension funds as at the 30th of June in the year. I think one of the key points of this, and why I believe it probably will be reintroduced at some stage, is that it's very simple for the government to implement. There are largely a small number of very large pension providers, and the administration of the tax liability is quite easy from a government perspective to collect. And given that back in 2014, this tax raised circa 800 plus million, given that pension funds have grown in the intervening period, even at a similar rate of liability of 0.6 or 0.75, there would be able to get north of $1 billion in income quite simply by introducing a levy for a relatively short period of time. And I think from a political perspective, I can see a huge will to contest it, because it's not affecting the majority of people. There's slightly less than half people have private pensions, and so for the more significant ones, it would be affecting them greater than it would be the normal people. And so I can see this being a relatively simple addition into their armory in terms of tax collection over the next while. Not sure it will be for 2021, but I can see it in the early 20s. The next one, and the high earner levy would have got quite a bit of traction last October. Sinn Féin, when they were setting out their policies, were saying that they were very much in favour of a high earner levy. Their rate of high earner was anyone earning over 140,000 in their budget submission. I suppose there are already levies to some degree on high earners, and that there is the high earners restriction. Again, it's a quite easy tax for the government to collect. Irish Revenue, to be fair to them, are the most well regarded in being able to administer collection of taxes. So if there's an extra tax put on high earners, I don't think it's going to cause a difficulty from an administrative perspective. And if there's certainty on the level of the income that they decide on, then it's quite easy to apply the levy. As I said, Sinn Féin's had suggested that it was 140,000 and apply a 5% levy. Interestingly, looking at the statistics of the Irish working population, only 10% or slightly less than 10% earn over 100,000. So in terms of the amount of money that this could bring in, it would be a lot less than what the pension levy could bring, and I think it would cause a lot more waves and arguments than necessarily the pension levy would. The follow-on, I think Una, to be fair, has touched on it in terms of the various reliefs. For those that follow this, you will have seen that in the UK, which Ireland would typically follow broadly, had entrepreneur relief at 10 million sterling, and Ireland was expected to start following that over the course of the next number of years, going from 1 to 2 to 5. The UK, in their budget last April, slashed it from 10 million back down to 1 million. So in terms of the sentiment towards these type of reliefs, I think they're waning at the minute, to be perfectly honest. I think on the business asset / retirement relief, I do think there is still a strong belief that people need to pass on businesses, and so I think entrepreneur would more likely to be impacted, I think, than the business asset and retirement relief, but that's a personal view. And so finally, the wealth tax, and again, this has often been mooted, often discussed, and I think it's a difficult tax, and it would be a difficult tax to implement, because assuming a 1 million has been an amount that has been mentioned, how do you value what is 1 million? For those of you that know me, I come from a small farm in West Kerry. If you take the farming as a community, very hard to estimate what the value of a farm is, if a farm is going to be included in a wealth tax calculation. The same for those in the broad construction industry. If you own a construction business, is the tax on you? How do you assess the value and of the company that you may own? So I think as a tax source, it may well be there and might get an awful lot of media commentary, but I'm not sure it's a simple tax to implement. And I think the three above it are certainly much easier to implement. And I think for a stable government, I think a wealth tax will necessarily create a big industry in terms of advisors looking for alternatives for their high net worth clients, who will be seeking to minimize their exposure to the wealth tax, much more so than they would in terms of a high earner levy or indeed a pension levy, because to my earlier point, the amounts on which the tax will be levied are very certain in terms of those, and ultimately everyone likes certainty. Just to cover off on that piece, I suppose I titled it possible and probable, and I probably should have said and vice versa, because we don't know what is coming down the track. We do know for certain that, back to the Taoiseach's comments, we will have to pay for our own liabilities at some stage. But to Una's point, our advice is based on certainty as we are now, and this is merely to give a flavour of what may come down over the course of the next couple of years. So in terms of the future, we will obviously be looking at the budget, and there was talk early in the COVID crisis that there was going to be a quick budget some stage in April, early May. That has obviously passed now. So I think there will be changes coming from the budget, and we'll obviously keep a very close eye on what is happening. But for the moment, I think these may come down the line, but they're not in yet. In terms of, and I know we're moving on time, there are a couple of questions that we have got in, and rather than moving them all to reply individually, we might just cover two. Una, I might ask you to cover on two for me. We're asked if disposals are relieved for CGT due on retirement leave, is the CGT and CAT offset available? And the other question, if you can remember the two of them, please, do you have any experience of revenue challenging family loans if they are not repaid by time of death of the lender? Only, can I just ask you to comment for just a minute on those, please?
Yeah. So in relation to the first question, if disposal is relieved of CGT due, is the CGT cash offset available? So I suppose for people that aren't familiar with the CGT cash offset, that is essentially the cash liability is a credit against the CGT paid. So very simply, if you suffer a CGT of 10,000 and you have a CAT liability of 12,000, the person, i.e. the recipient who's paying the CAT, will only have to make a top-up payment of 2,000. So it's a credit. Basically then, if you avail of entrepreneur relief, you're still being taxed. So your first million is at 10%, your excess is at 33. So the CGT liability would probably be significantly lower in that instance, and you can get a credit for the CGT paid only against your CAT liability. So in that case, the CGT would be a lower amount and the CAT would probably be a higher amount, so the recipient will be making a CAT top up. In terms of retirement relief, if you do qualify in entirety for retirement relief, then there is no offset available because you're not paying any CGT. It's been fully relieved. So an example of that would be if you gifted shares that were worth 10 million to your daughter and you avail of retirement relief, you do not pay CGT, so therefore there is no CAT CGT offset. So it's only there when you have a CGT liability. In terms of the second question, do you have any experience of revenue challenging family loans if they're not repaid by time of death of lender? So I've no experience of revenue challenging family loans, but I have advised where there has been family loans and they've either been waived or forgiven on death, or they've been passed to a survivor. Where they've been waived or forgiven, it is a CAT liability for the recipient or the recipients of the estate, and generally be attaching to the shares. Also, if there is a family loan and it's waived or forgiven at the time of death, whoever was supposed to receive the benefit of the family loan, they will be subject to CAT. So it is a taxable benefit and it is subject to tax. We've also had cases where they've passed it on to their wife, so the benefit of that loan goes to the wife. In that case, it's completely tax-free because of spousal exemption, but they are taxable events.
Thanks, Una. Just one other that I'm just going to deal with quickly in terms of the potential pension levy. Would it apply to approved retirement funds? All I can say on that is it didn't the last time, but that is not to say that it wouldn't. And the follow-on question was, should people consider drawing down their benefits now? I suppose our view is always that you should delay drawing down your pension benefits for as long as possible, because of the tax efficiency of leaving them within the structure. That being said, if somebody wants to not be dealing with a potential levy, then obviously the option is there. If they are entitled to draw them, they can. It wouldn't be our normal view to say rush to encash pensions in order to avoid a levy, pure and simply on the basis that you're also going to have an imputed distribution on the other side every year once you draw on your pension benefits. So just there are a couple of other questions and we'll deal with them individually. If you have any topics that you want us to deal with in future webinars, feel free to use the chat box or the comment box and send them through to us, and we'll certainly do our best. I hope you found it of benefit. Thank you for joining, and we look forward to you joining us again on the 24th of June for our next private client webinar. If there are any other comments that any people have, we have our private client email address there, privateclient@ie.gt.com, or your normal GT contact, and we will look to deal with any queries that people may have arising from this. Many thanks again, and I hope you all stay safe and enjoy the rest of your day. Thank you.